Welcome, everyone, and thanks for joining us for today's webinar entitled Tax Planning for Business Owners in 2018. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limberg, and regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available on Amazon. Linus will draw on his legal, tax, life insurance background, and practical experience for today's webinar. And here he is.
Thanks, Jennifer, and good morning or good afternoon, everyone, depending on where you are. Welcome to the continuing saga of the Tax Cut and Jobs Act. I say that a little facetiously. The new tax law is not yet 3 months old. We have lots of information about it, and we still have lots of questions, particularly about business taxation. Jennifer and I have been taking a lot of calls asking questions about the effect of the Tax Cut and Jobs Act, particularly about how it will affect our business owner clients. We have some answers. We have a lot more questions. And I'm going to kind of go through what we think we know and what we think we don't know about business taxation on the call today. I know many of you who are on the call perhaps have your own businesses, and you're going to be directly affected by the rules as they apply to your businesses, and you're interested in figuring out what plans you might make to minimize your taxes going forward. I want to assure you that I am in that category as well, so I have a lot of interest in the answers. But our clients, of course, are also interested in business taxation, our business owner clients, and they want to implement strategies that will help them to pay as little tax as possible as well. And so we'll talk about those kinds of things that we might suggest that our clients ought to be thinking about. And of course, the bottom line is going to be that our clients have to talk these things over with their business CPAs so that they can identify all the moving parts in making any kind of adjustments so that they can minimize taxes. We're not sure about all the details, but we're going to do our best to talk about business taxation under the Tax Cut and Jobs Act in the next 15 minutes or so. So let's go ahead and get started, and let's start with a very brief review of the Tax Cut and Jobs Act, which was signed into law less than 3 months ago. The process was hurried, which is part of the reason that we have many unanswered questions. There were major changes to the income tax structures for individuals and for businesses. Most of our clients are going to see a net income tax reduction, particularly our best clients. And there were also significant changes to estate gift and generation skipping tax rules. There were 7 tax brackets for 2017. And I say were, our clients are still dealing with 2017 right now as they work with their tax preparers to prepare the income tax returns for 17. But 2018 also has 7 income tax brackets. Some of them are lower. One of the main changes that was highlighted as part of the Tax Cut and Jobs Act for individuals is that the standard deduction was substantially increased from $12,700 for a married couple filing jointly in 2017 to $24,000 in 2018. That will have a positive impact, particularly on those who do not itemize their expenses. It may have no impact at all, no net benefit for those who do itemize, depending on the amount of their itemized expenses. One of the downsides of the new Tax Cut and Jobs Act is that the personal exemptions, roughly $4,000 in 2017 per person, were repealed. There is a sunset provision in the Tax Cut and Jobs Act for almost all the provisions, meaning that the rules that we're talking about are effective through 2025, but they're scheduled to go away in 2026. Quick commentary on that. I don't know what that means in the real world. As a practical matter, it is unlikely that the rules will sunset and immediately go back to the way they were. What's more likely to happen is sometime between now and 2026, Congress, the then Congress and the then President will get together and come up with a new tax regime, which makes it hard for us to plan, but we might as well take advantage of the rules while we can. For individuals, for those who itemize, their ability to take itemized deduction is potentially curtailed. The healthcare mandate penalty has been repealed beginning in 2019. The personal alternative minimum tax will affect far fewer taxpayers than it has in the past. And recharacterization of Roth conversions will no longer be possible beginning with conversions in 2018. Estate and gift taxes have changed. What was essentially scheduled to be a $5.6 million exemption per person in 2018 was increased to essentially an $11.2 million exemption. That number may change a little bit as the IRS figures out which cost of living index it's supposed to use. But likely to be $11.2 million per person, $22.4 million exemption for a married couple, still a 40% estate tax rate, still portability of unused exemptions, and for a lot of our clients, that means that they don't have to worry about estate taxes, so that market is smaller for us. Doesn't mean that we don't have to do estate planning work anymore. There's no opportunity there. It's just means that federal estate taxation is going to be less of an issue. So let's get into the meat of what we want to talk about today, which is the business income tax changes. And I want to spend most of the time today on the 20% deduction for pass-through business income. First of all, to reinforce pass-through businesses, we have three kinds. We have proprietors, partners, and S corporation shareholders. Those are the pass-through business entities. We often get asked about LLCs, and LLCs are kind of a hybrid entity. They are designed to provide limited liability for the owners, so in that way they mimic corporations. But in nearly all cases, the LLC owners, or members as they're called legally, the LLC members have the ability to choose how they're going to be taxed for income tax purposes. So just because someone is an LLC, don't assume, for example, or just because they have an LLC entity, don't assume, for example, that they're taxed in any particular way. They've got the ability to choose to be taxed, for example, if they have more than one member, as a partnership, as an S corporation, or a C corporation. So if your business owner client tells you that they are an LLC, you got to dig a little bit deeper and ask them how they've chosen to be taxed. So in any event, for a pass-through business, there is a potential 20% business deduction available for certain pass-through business income. And what does that mean? If you have income, total income, not just business income, but total income that is lower than the threshold, you're eligible to take the 20% deduction on your business income. If you're over the threshold, the deduction depends on the kind of business that you're in, and a couple of other factors, including how much W-2 income you take as an owner and what your depreciable business assets are. Now, I found this chart online. You can see the source right underneath the chart. about what the rules are with regard to whether or not you get the 20% deduction. And so if, for example, you have taxable income that is less than or equal to the threshold, then you don't have to worry about W-2 income in order to have the deduction. It doesn't matter what kind of business you're in, you have the ability to take the 20% business deduction. Now, there's still some uncertainty associated with it, and we're going to get into that in a second. But that's the rule. So if you're if you're a lawyer, for example, lawyers are specified trader business means they're not eligible to take the deduction if their income is over the limit. So there's a phase out so that if your income is more than the threshold, but less than about 100 grand or 50 grand over the threshold, then your ability to take the deduction is going to be more limited. And so that calculation becomes pretty complicated. I'm not going to get into any examples because I think they're confusing. But understand that you won't get a full 20% deduction if your total income is a little bit over the threshold. And if you are way over the threshold, the last category on the chart here, then if you're in a specified service business, you don't get any deduction for your pass-through business income. And if you're not in a specified service business, then you've got the complicated formula to figure out what your business deduction actually might be. So this is the short explanation, and you can see why this new provision really isn't tax simplification. It's made things much more complicated. All right, let's move on to the next slide. And so if the income is over the threshold and the business is a non-excluded trader business, right, a specified service business, then the deduction can't exceed 50% of W-2 wages from the trader business, or 25% plus 2.5% of the unadjusted basis of depreciable assets. You can't make this stuff up, folks. So that's the rule. And so it does take a CPA to help figure out if someone's over the threshold and not in a specific service business, whether the deduction might be available. So the first question that you might ask is, what is a specified service business? If you're in a specified service business, remember that you don't get the pass-through deduction if your income is over the top threshold, roughly 400 grand for married filing jointly. So here's kind of paraphrasing the code. Here's what it says. It says a specified trader business means any trader business involving the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, or brokerage services, right? So those are pretty clear, and it feels likely that a financial services firm, including an insurance agency, is probably going to fall in the definition of a specified service business. There are some other factors that might make somebody a specified service business. It's any trader business where the principal asset of such trader business is the reputation or skill of one or more of its employees. What does that mean? We're not exactly sure. And then there's a third test. Performance of service that consists of investing and investment management, trading, or dealing in securities. So clearly, a financial services firm falls either under the first or the third definition. So the natural question is, what does this mean in the real world? What specific kinds of businesses are included in one category or another? And the answer is we're not exactly sure. We know what the broad categories are and we can make some guesses, but the actual determination will require regulations from the IRS. We don't have those regulations yet. We don't have regulations that apply to the other code sections that kind of define specified service businesses. And we don't know whether any regulations that do exist with regard to other code sections would apply to this new section 199A, which creates the pass-through business income deduction. So a lot of unanswered questions there. So the next question is, what is qualified business income? And this is really kind of the interesting question to me because it has the potential to affect my business, but it'll affect a lot of your clients as well. So let's set, and I think using an example has a chance to drive this point home. So let's say that we've got somebody who is in any kind of a pass-through business, right? Got a pass-through business and is married filing jointly, and the only income for this couple is the business income. And let's say that the total business income is 300 grand. Let's just say all of that is true. And so remember, if we look at the chart, that if the top left of the chart, taxable income less than 315 joint, means that the business deduction is available no matter what kind of business we're in. So 300 grand of income in a business. So let's say that we've got an S corporation, and the S corporation pays a salary to the owner, and let's say it's a single owner, a salary to the owner of $100,000, and the rest of the income from the business is business profit, $200,000. So the owner pays FICA on 100 grand of S corporation salary and doesn't pay FICA on 200 grand of profit. What the law seems to say is that while the business earned 300 grand, because the business owner took a salary of 100 grand, the 100 grand is not eligible for the 20% deduction. It's only the other 200 grand that would get the 20% deduction, which means that the deduction for the business income, the pass-through business income deduction, would be 20% of 200 grand or $40,000. That seems to be what the law says. So that's an S corporation, and that's the easiest example. Let's say that, again, the owner is part of a partnership, and let's say that the owner's share of the partnership income is 300 grand, just like in the first example, and that's the only income for husband and wife. The question is, where it's partnership interest, there is no salary for the owner of the company. All 300 grand of partnership interest is going to be subject to FICA. And so the question is, how do you determine the business income under those circumstances? And the answer is we don't know for sure. We think that if the partnership pays a partner kind of a guaranteed payment, some kind of guaranteed salary equivalent, that will be subtracted out, and that the deduction can only be taken on the remainder. In the real world, the guaranteed payment to a partner is a little bit arbitrary. It hasn't really mattered too much in a lot of cases in the past, at least for tax purposes. And so we may see a lot of circumstances where partners in partnerships lower their guaranteed payments so that they can take a bigger tax deduction for pass-through business income. There may be regulations that'll prevent that, but we haven't seen them yet, so we don't know. Let's take the third example. Let's say that it's $300,000 of business income, married filing jointly. It's the only income for the couple. But instead of being a partnership or an S corporation, it's a proprietorship. How much of the business income is available for the deduction then? And the answer is we don't know. We don't have the equivalent of guaranteed payments in a proprietorship. All of a proprietor's income is subject to FICA. It's considered to be earned income from the business. And so, the question is, what do we apply the 20% to? And the answer is we really don't know there. We probably have to take a guess as to what reasonable compensation would be in a proprietorship situation and subtract that out of the business income and take the deduction, the 20% deduction on whatever is left. But we don't know. And so that's why we need regulations from the IRS to kind of figure that part out. So what else don't we know? Well, accountants want the IRS to help out and answer some questions about the following things in this list. And that is, what if a business has multiple activities? If some activities are specified, or if they were separated out, would be specified service business, but some wouldn't be. Is it possible to allocate some? Is it possible to get to essentially split out a business and take a deduction for some of the activities that generate revenues? One of the other unanswered questions is the deduction potentially available when a pass-through entity has a loss? For example, if you've got a proprietorship in a loss position, but if reasonable compensation for the proprietor's business activity, should be taken into consideration, shouldn't there be potential deduction as if the business had a profit? We don't know. And then finally, rental activity. It's one of those gray areas as to whether it's the activity generates earned income or not. Does any rental activity qualify for the pass-through deduction? We don't know that either. So, a lot of unanswered questions yet. Stay tuned. We may talk. In fact, I'm sure we'll be talking about this as the year goes on, particularly after we get regulations. Briefly, C corporations. The income tax rate for C corporations used to be 35%. The maximum rate used to be 35%. Now it's capped at 21%, including for C corporations that are personal service corporations. The corporate alternative minimum tax has been repealed. That's good news for our C corporation owners. And the question we get asked a fair amount is, should my business owner client consider changing from a pass-through entity to a C corporation? And the lawyer's answer, it depends, applies here. Depends on a lot of factors. The most significant of which is, I think, does the business generate a lot more income than the owner actually needs to live on? And if the answer is yes, then certainly the owner ought to think about changing to a C corporation. Not saying that they need to change, they ought to think about it, and certainly you want to be part of that conversation between the business owner and their CPA. And so what takeaways do we have from all of this certainty and uncertainty? The first thing is that we hope to have regulations. The IRS has a goal of publishing regulations on the new pass-through business rules in the second quarter. I'm not sure exactly what that means in the real world. That's their goal. What it probably means is that I wouldn't expect to see regulations anytime before June. And hopefully we will get regulations in June or shortly thereafter, and that we can start to make real plans as opposed to making guesses about how this is going to work. Obviously, there's an opportunity for us to educate our clients about the new Tax Act, and particularly our business owner clients about what's going on with business taxation. Definitely an opportunity to collaborate with our clients and their CPAs. Now's a great time to be marketing to CPAs with information and suggestion that we get those conversations lined up for later on in the year at a minimum, perhaps now, if appropriate. Certainly, C corporation change or formation ought to be considered. And then the direct benefits for us in our business, business-owned life insurance is more attractive because, particularly in C corporations, because the tax rates have gone down. Things like key person, deferred comp, entity purchase, buy, sell, and split dollar in conjunction with C corporations are things that ought to be considered as we go forward. I want to thank you for joining us today. I know that we didn't answer a lot of your questions, but at least we said, I don't know, in a sophisticated way, which we sometimes do. If you've got questions for us, feel welcome to reach out. We're available to you, to our clients, free of charge. We also have our videos posted on our YouTube channel. Feel welcome to think about subscribing there. And at this point, I would like to turn it back over to Jennifer to close us out. Jennifer?
Thanks, Linus. And thanks for joining us today. And consider joining us next month for what every financial planner needs to know about Form 1099-R. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultations and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. And as Linus said, we post all of our webinars on our YouTube channel, and I will be sending all of today's listeners a link to this presentation as well as our YouTube channel, so you can subscribe there if you would like. Thanks again, and best wishes for continued success.